Hey there, thanks for tuning in. Welcome to Investing in Germany, and today it's time for the weekly market update. On the 1st of March 2023, we had the German government publishing the CPI number or the inflation data for the Germany, which is not really good news here, plus 8.7 from a year-on-year basis, 0.8% on a month-on-month basis. This is not really a good sign, I would say. And it's not only that, also the harmonized CPI index, which is nothing but a process which all the euro area countries follow so that the numbers coming in from different euro area countries are comparable. And here also you can see 9.3 and 1.0 percentage. It's going in a really wrong direction. We have to really wait and watch how it really progresses. But what is clearly we can see here is that the inflation is really eating up into our free cash flow, what we have from our pocket. And it's gonna be really terrible for us here. And it's not only the Germany economy facing the inflation, high inflation environment, it's also the euro area. You can see here, even though the headline inflation has really cooled down to 8.5% thanks to the price breaks and energy price stabilization within the euro area, thanks to the Norway providing us a lot of gas and oil, and also Qatar and so on, who are really helping us in combating or helping us to fill the Russian gap. But then what you can see here is the core inflation data, which is always going up. Of course, this is the completely wrong direction. What it really means is that we as a consumer are facing a really high stress of inflation, because whenever we go out for a coffee, whenever we go for a dinner, the prices are increasing. The service base is really increasing, and which means that people who are working in the service industry is also getting more wages because of the high inflation rate and so on. So this is really going like a chain of reaction, and we have to really bring the interest rate into a restrictive environment, which makes that people not to spend more. So what really happens here with the restrictive environment is that the cost of capital is so high, people don't go out for food, people don't go out for coffee in Starbucks and so on, and they try to save the money. It's not only consumer, but also the companies, right? The companies, they stop the investment cycle, they try to preserve the money because they are going to expect a low demand for their products and low revenue, so they have to survive through this down cycle, so they stop invest in the capex. Therefore, there's not much real activity in the economy. So that is what the monetary policymakers are really trying to push the interest rate towards the restrictive environment. But what we can see here is that current interest rate is not in a restrictive mode. I would say it's fairly evident that the interest rate is going to go up. At ECB level, we already have a confirmation that in March 2023, the interest rate will go up by 50 basis points. And if this core inflation increase persists, I would say maybe next month also we might have 50 basis point or a 25 basis point increase in the interest rate, which the market is not really factoring in. If you look at what happened as soon as the data came in from the inflation data, the market really crashed. And after that, the speculators and the traders, they thought it's not going to be the same for the next month. Again, they started purchasing, and then we can see the market already going beyond. I would say that here the traders and the speculators are betting against the monetary policy makers, betting against the inflation. Whether they are right or wrong is something that nobody knows. So we have to really wait and watch how the market really comes in. But then we can see that the ECB main board members are really expecting that even 4% hike is really possible. It's really in the card because the core inflation is not really going down. So this is not something the traders and speculators are factoring it in, and they are expecting the market should do well and the inflation should come down probably soon. So let's wait and watch who wins here. But we as an investor, we have to really be careful in selecting the companies where we are investing in, because the high interest rate environment is something really, really crazy for the businesses. If the business came out into the market maybe in the last 10 years, they were never exposed to a high interest rate environment, which means that the cost of capital really goes up, which means that it eats into the free cash flow, and therefore they don't have much money to do the business or do whatever they want to do with the money, right? So we have to be really careful in choosing the companies, and I would say we have to really stick to the high quality, high management companies who know what high interest rate environment is, which means that we have to go for the companies which is in the market for at least last 20 years or so that they know how exactly it works in a high interest rate environment. And we also had the monetary policy report coming in for the Federal Reserve, In the America, this is a semi-annual report where they also clearly mentioned that the interest rate will go up because they want to bring the interest rate to a restricted environment so that they can reach the 2% target inflation rate, which you can see in these lines here. The link to this document I will add to the description. You can go and have a look. It's not such a big document, but it really gives you a forecast that the interest rate is going to stay there for a while in a high level. And therefore, we have to be really careful in selecting the businesses where you want to invest in the next couple of years. And we also had Mr. Scholz traveling or flying to America to meet Biden. Here, the discussion was not focusing on the economics or for the businesses, but then here is mostly relevant to the war that is ongoing between the Ukraine and the Russia. And you can see here the market was really happy to see, and they really pumped up the Rheinmetall, which is providing the tanks and providing military equipments for the German government and also for the whole world. It's also going up. The market is not expecting that the war is going to come down anytime soon. But of course, there is also a report saying that by 2024, the Russia will be not able to invest in the war because they will run out of money thanks to the sanctions and so on. But this is all prediction, so we don't know how much cash the Russian government is now having, and nobody knows what exactly the cost of the war here for the Russia. So let's wait and watch here. But I'm not invested in Rheinmetall. I just was curious to see what happened there. And we had the Meta platform slashing the price of the Quest Pro, which is nothing but a virtual reality headset, which is the next needle mover for the Facebook, right? They are investing billions and billions in the virtual reality and metaverse and so on. And here they are reducing the price. Of course, on a surface level, it might look good because it increases the demand and so on. But there are also some insider news coming in from the Meta platform where they are pointing the fingers at the low demand for these products in the market, and therefore they are reducing the price so that they don't want to lose the market share of their virtual reality headsets. Of course, this is not the only free cash flow for the Meta platform. They are really cash heavy. They already have a lot of cash coming in from the advertisement market for the Facebook, Instagram and so on, and they're also planning to start a monetization plan for the WhatsApp for the business. So there are quite a lot of catalysts available there. Of course, I'm invested in Meta platform, therefore my view could be biased, but then I'm really positive on Meta platform, and I don't think the current price justifies the quality of the business what the Meta platform is bringing in. We had also news coming in from China where the airport makers for the Apple is moving or is creating a production site in Vietnam. It looks like Apple is pushing its power towards diversification of the supply chain outside China. You can see here, even though they don't want to name the company here, but then this company has already told that they want to diversify, and all their customers are really asking for diversification in their supply chain. So Vietnam, Thailand, and all the other South Asian countries will be really happy to welcome these companies and increase their GDP growth. And where Volkswagen is investing in America, they are creating or building their own EV facility, manufacturing facility in South Carolina. Now it's all fixed. And what I see from this report is also that Volkswagen might be really in a negative sentiment in America, because that's why they are trying to build a new brand, Scout brand, which they already own. So they are trying to push into the market of the EV segment in the America through a different brand, maybe because of the Dieselgate, where their name got really punctured there. I think they are now trying to rebuild a new brand so that they come out of the name Volkswagen, so that they can create more demand there. So let's wait and watch. They're expecting the new truck to come out by 2026. I'm not sure if they will meet the target because of the downturn, recession, and so on. Probably plus minus 1 year, it should be in the card. So let's wait and watch. I'm invested in Volkswagen, so my view might be biased, so keep that in mind. And finally, we have Amazon coming in and pausing the construction of its second headquarters in the Washington, D.C. Of course, this is really predictable because they just slashed 18,000 jobs. So why would they need new buildings if there are no people to work in and fill in the buildings, right? What I can see here from the different companies around the world is that everybody are going into a lean mode. Lean mode meaning that they are trying to reduce the expense, reduce the capex, reducing the headcounts, and they are predicting or they're estimating that the revenue generation for the next couple of years is going to go down. Of course, this is clear because we are really pent-up demand from the COVID, but then I think they will not be reaching the pre-pandemic level of their revenue in the coming months and coming quarters. And I think that is one of the reasons why they are going for a lean mode. It's not only Amazon which is stopping this construction of the headquarters, but also we had Facebook reporting that they are taking a $2 billion cut because they are canceling several contracts with the office space providers. It's not a really good sign to see that people are being laid off and so on. But then as an investor, I would say this is a good sign for a company because now they are thinking lean. Because at the high interest rate environment, it's all about cash in the hand. It's not about the debt. So at low interest rate environment, the cash was always free. So they were really able to get all the debts for a really cheap price and create more wealth. At high interest rate environment, they have to really preserve their cash, and the cash should be in the balance sheet, and they should be really focusing on the lean. So that's what I see here. All the big companies around the world are really slashing their headcounts and slashing the expenses. I think it's a good sign to see as an investor. So I think now it's the right time to be in the market as an investor, because as I see here, the companies are expecting low growth. As soon as the low growth kicks in into the P&L statement or the quarterly report, and all the speculators and traders, they go out of the stock, which means that the stock goes down crashing. And that's a real time that we as an investor should really go ahead and buy the stock. So Warren Buffett says that we have to be greedy when the market is fearful. So that's a time to be in. I think that time will come probably this year or at least next year. And I am waiting in the sidelines. I'm also investing and also waiting in the sidelines. So I'm not completely invested. So let's wait and watch how it really progresses from here on. And finally, we also had Tesla coming in with an investor day report this week. And the market was really not happy to see that there was no news about the $20,000 car or 20,000 euro or dollar car in the market. Of course, why would they need to provide if they're not able to launch the Cybertruck, which was released several years back, right? That's it for today. Thanks for watching. See you in the next video.